Central banks are still talking about a neat, clean 2% inflation world, but the economy you actually live in looks nothing like that anymore. Deglobalization, aging populations, climate shocks, and record debt are quietly rewriting the rules. And if you keep planning your money around 2%, you're building your future on a broken assumption. In Brian, I have worked in fintech and banking for decades. I got a finance degree and an MBA as well. And in this video, the whole point is simple: to show you why the 2% era is probably gone for good, and what that means for your cash, your investments, and your career. Let's start with a brutally honest question. What if 2% isn't a target anymore? It's just a marketing slogan. For years, that number felt automatic. You had a globalized world, cheap labor, deep supply chains, low interest rates, and more or less manageable government debt. Central banks looked like magicians because the backdrop was doing half the work for them. That backdrop is gone. The forces driving prices now are structural, not cyclical. Higher inflation isn't just a spike. It's becoming the new floor. The first structural force is deglobalization, and this one hits you straight through the checkout line. For decades, companies could chase the absolute cheapest place on earth to make your phone, your clothes, your electronics. That made everywhere model push prices down and made 2% inflation easier to hit. Now that engine is running in reverse. The US-China relationship has shifted from strategic partner to strategic rival, and that shows up as tariffs, trade restrictions, export controls, and investment bans. Every one of those frictions is a cost. Think about what's happening with tariffs in particular. When a government slaps higher tariffs on imports, companies don't just eat those costs out of kindness. They raise prices, change suppliers, or both. That means you either pay more for the same product, or you get a more expensive version made in a friendlier country. Add that to thousands of new trade restrictions in recent years, and you're looking at a world where moving goods is permanently more expensive and more complicated than it was in the 2000s and 2010s. At the same time, companies are moving from just-in-time to just-in-case supply chains. That sounds like corporate jargon, but it has very real consequences for you. Just-in-time means razor-thin inventories and maximum efficiency. Just-in-case means holding extra stock, using multiple suppliers, and sometimes producing closer to home. That makes the system more resilient, but also more costly. Reshoring, nearshoring, and friendshoring are nice buzzwords, but you don't get them for free. If you stop using the cheapest worker in the cheapest factory on the planet, your costs go up. Here's a simple way to translate all the deglobalization talk. Every time you hear resilient supply chains, think baked-in price pressure. You might not notice it immediately because companies smooth it out, play with margins, or hide it inside premium versions. But over years, this shift acts like a slow-moving tax on consumers. That's a key reason the world is drifting toward a higher inflation baseline rather than snapping neatly back to 2%. The second structural force is demographics, and this one is slow, predictable, and ruthless. Rich countries are getting older. That means fewer workers, more retirees, and a rising dependency ratio, more people drawing pensions and healthcare benefits, supported by a shrinking pool of active workers. For inflation, that's a toxic mix. When labor is scarce, workers have more bargaining power. Employers must raise wages to attract and retain talent, especially in essential service sectors like healthcare, logistics, and skilled trades. Higher wages are great if you're the one receiving them, but they also feed into higher prices. Most services are labor-heavy. Think childcare, elder care, hospitality, repairs, education, medical services. When wages rise in those sectors, businesses pass a chunk of that cost on to you. That's why services inflation tends to be sticky. Goods prices can fall when supply chains normalize or technology improves, but service prices rarely go backwards. In an aging society with structural labor shortages, that stickiness gets worse. Then there's the government side of aging. When more people retire and live longer, pension and healthcare bills explode. Governments have three options: cut benefits, unpopular; raise taxes, also unpopular; or borrow more and hope growth and inflation bail them out later. Guess which path is usually chosen? Higher age-related spending funded by more borrowing adds another layer of pressure on the system. You end up with bigger deficits and more debt in a world that is already drowning in IOUs. If you've ever wondered why it feels like you work harder to stand still financially, demographics are part of that story. Fewer workers, more retirees, and rising care costs mean the system quietly leans on you through taxes, through prices, and through the erosion of your future benefits. That's not a 2% world. That's a grind higher inflation world. Now let's talk about the monster everyone knows about, but nobody really plans for properly. Debt. Global debt, governments, households, corporations combined, is now more than double global GDP. That was survivable when interest rates were near zero. It is a very different world with higher yields. Once central banks hiked rates to combat the post-pandemic inflation spike, the interest bill on that mountain of debt exploded. For many governments, debt servicing is now one of the biggest budget items. When interest costs eat a huge chunk of tax revenue, governments get trapped. Do they slash spending and risk recessions, protests, and political chaos? Do they raise taxes and anger voters and businesses? Or do they let inflation run a little hotter, quietly shrinking the real value of what they owe? History tells you exactly how this usually plays out. Inflation becomes a politically convenient, silent partner. Officially, the target stays at 2%. In practice, policymakers tolerate something higher for a bit longer, and that bit longer turns into the new normal. There's also a financial stability angle. If central banks kept rates extremely high for years to crush inflation down to exactly 2%, heavily indebted governments, banks, and corporations could crack. So they walk a tightrope, talk tough on inflation, but pull back before the system breaks. That safety instinct is rational, but it also means inflation never gets fully squeezed out. It settles in a higher range. You end up in a world where 3% becomes good enough, even if nobody wants to say that out loud. The fourth structural force is climate change, and this is where economics and the real world collide. Extreme weather is no longer a rare event. It's annual, sometimes monthly. Heat waves, floods, storms, and droughts damage crops, destroy infrastructure, and disrupt logistics. Every time major harvests are hit, food prices jump. Every time critical infrastructure gets knocked out, rebuilding costs surge and insurance premiums rise. Food and housing are big parts of your budget. When those prices rise repeatedly, they anchor higher inflation expectations. On top of that, you've got the cost of the energy transition. Moving from a fossil fuel heavy system to a cleaner, more resilient grid requires trillions in investment. Renewable capacity, storage, transmission lines, EV infrastructure, climate-proofing cities and ports. Over the long term, that can boost productivity and maybe lower certain costs. But in the near and medium term, it often raises prices. Carbon taxes, stricter regulations, and higher input costs for energy-intensive industries don't magically disappear. They trickle down. Put all of this together and you see the pattern. Deglobalization equals more expensive supply chains. Aging equals tighter labor markets and higher wage-driven services inflation. Debt equals pressure to tolerate higher inflation to avoid fiscal and financial crises. Climate equals repeated supply shocks plus massive transition spending. Any one of these would make 2% harder. All four at once make it borderline unrealistic as a stable, long-run baseline. That doesn't mean inflation explodes into double digits forever. It means instead of oscillating neatly around 2%, it might stabilize more around 3 to 4%, with frequent spikes when something breaks. War, tariffs, climate events, energy shocks. So what does this higher baseline actually mean for your money? Let's start with cash. Cash is still important for emergencies and short-term needs, but in a structurally higher inflation world, it's a terrible long-term asset. At 2% inflation, prices roughly double in about 35 years. At 3 to 4%, they can double in about 18 to 24 years. That's your rent, food, healthcare, and retirement lifestyle quietly slipping away while the number in your bank account looks the same. If you're hoarding cash because it feels safe, understand that you're choosing a guaranteed loss in purchasing power. Next, fixed income. Traditional bonds and fixed deposits become much trickier. If your bond yields 4% and inflation runs at 3.5%, your real return is barely positive. If inflation is underestimated, you might actually be losing purchasing power. The old mental model, bonds are safe, stocks are risky, was built in a world of falling inflation and falling interest rates. In a higher inflation, more volatile world, safe instruments can quietly destroy your real wealth if you don't pay attention to the inflation-adjusted return. That doesn't mean abandoning bonds. It means being more strategic. Shorter maturity bonds, inflation-linked bonds where available, and higher quality credit can still play a role. But you can't just lock into low yields and assume inflation will meekly slide back to 2% to save you. Your fixed income allocation has to be designed around the idea that inflation might average higher than what central banks still claim to be targeting. Now, real assets start to matter more. Historically, certain types of real estate have been decent inflation hedges, especially when rents can be adjusted and demand is stable or growing. Not all real estate is equal. Office space in a dying downtown is very different from residential in a growing, supply-constrained area, but the general idea holds. Owning productive, scarce, real assets helps protect you from a rising price level. Commodities and commodity-linked stocks also gain relevance in this environment. Energy, metals, agriculture, all are directly tied to inflation dynamics and to the big transitions in trade and climate policy. Another piece people underestimate is equity in high-quality, cash-generating businesses with pricing power. Companies that can raise prices without losing customers and maintain healthy margins can pass inflation onto the market instead of absorbing it. Owning slices of those companies through stocks or ETFs can be a powerful way to keep your portfolio anchored to the real economy rather than to nominal promises. In a world that's more inflation-prone, owning productive assets beats owning IOUs. Fighting higher inflation with savings accounts and low-yield bonds is like fighting a forest fire with a water pistol. You might slow things down a bit, but you're not winning that battle. You need tools, assets that can grow faster than the fire spreads. There's also your income side, and this is where most people fall asleep. In a structurally higher inflation world, your salary growth is just as important as your portfolio. If your wages grow slower than inflation, it doesn't matter how clever your asset allocation is. You are losing ground. That means you have to treat skill building, career moves, and negotiation as core parts of your inflation strategy. Choosing industries with structural tailwinds, roles with bargaining power, and employers that actually keep up with the cost of living becomes a form of financial self-defense. Think about wage negotiations differently. In a low-inflation world, missing a raise by 1% one year didn't kill you. In a 3 to 4% world, repeatedly accepting cost of living increases that lag reality compounds into a massive lifetime shortfall. If prices are rising faster, you need your skills, your output, and your bargaining skills to rise faster too. You can't control macro policy, but you can control your human capital. Your saving strategy also needs a complete recalibration. If you're using a retirement calculator that assumes 2% inflation, update it. Plug in 3 to 4% and see what happens to your number. Spoiler: the target jumps, sometimes dramatically. That might feel discouraging at first, but it's much better to confront reality now than find out at age 65 that your nest egg buys 30 to 40% less lifestyle than you expected. Instead of aiming for the smallest possible enough, you need to build in inflation resilience. And remember, this isn't about panicking. It's about adjusting. Higher baseline inflation doesn't mean you can't build wealth. It means you have to be more intentional. Less lazy cash beyond your emergency fund. Smarter, inflation-aware, fixed income choices. More exposure to real assets and businesses with pricing power. A deliberate plan to grow your income faster than prices. Financial models and retirement plans that assume a higher, more volatile inflation path. The 2% inflation target belonged to a very specific world: hyperglobalization, abundant cheap labor, relatively low debt burdens, and a climate that hadn't yet turned into a full-blown economic risk factor. That world is gone. In its place is a more fragmented, older, hotter, more indebted global system where 2% isn't impossible for short stretches, but it's no longer a reliable anchor. Central banks can still influence inflation, but they can't fully override these structural forces. If you keep planning your financial life around yesterday's inflation regime, you're setting yourself up to be quietly, slowly robbed by the new one. The people who come out ahead in this era will be the ones who recognize that higher inflation isn't a temporary glitch. It's a new baseline to design around. Build a plan that assumes more inflation than you'd like, aim for real returns above that hurdle, and treat your skills and income as core inflation hedges, not an afterthought. On this channel, the whole mission is to help you see around corners like this, so you don't wake up 10 or 20 years from now wondering where your purchasing power went. If you're still planning your life assuming inflation magically returns to 2% and stays there, it's time to update your playbook because the world that made that number easy is over and your money needs to adapt.